I'm Shubhajit. Hope you all are doing well. Today, we are going to learn about credit in financial system. Before understanding how the credit system works in India, credit is the availability of the money for people. The financial system is appropriate. And how does the system work? A system means interconnectivity with a group of people. The main theme of the lesson is how the deposits and loans work and why do people require loans. Let's see how the credit system works. Learning outcomes. Point number 1. Bank deposits as money. Point number 2. Loan activities of banks. Point number 3. Why do people require credit? Point number 4. 2 different credit scenarios. Point number 5. Terms of credit. Point number 6. Formal and informal credit. Point number 7. Self-help groups for the poor. Keywords. Number 1. Recurring deposits. A type of term deposit in which customers can invest money in installments. 2. Warehouse. A large building where raw materials or manufactured goods may be stored. Point number 3. Cooperative societies. People work together for a common goal, that is, welfare of its members. Point number 4. Self-reliant. Able to take care of oneself or itself. Point number 5. Uncertainties. Situation involving imperfect or unknown information. Point number 6. Collateral. A borrower's pledge of a specific property to a lender to secure repayment of a loan. Concept map. Bank deposits as money. Number 1. Bank deposits refers to funds placed in a bank by a customer for safekeeping. Point number 2. Banks are responsible for these funds and may use them to invest in other areas. Customers have access to the money at any time through various account types. Bank deposits differ from private currencies. Which lack an issuer or a set exchange rate with the local currency. Point number 4. In India, there are several kinds of deposits such as recurring deposits, fixed deposits, savings accounts, and current accounts. Loan activities of bank are as follows. The people who have extra money deposit the money in the bank. The bank offers them a % interest rate. Banks keep some money for the people who would come to withdraw the money. The rest of the money is used for giving loans to people who need money. Why people require credit? People require credit in agriculture because it gives them access to the capital that might not otherwise be available to them. Credit helps farmers to buy inputs, equipment, land, or other assets to improve their productivity and income. Credit also helps farmers cope with risks, uncertainties, and emergencies that may affect their crops or livestock. Credit is vital for the development of the agricultural sector and the rural economy. People need credit for many reasons, including buying a home or a car. Two different credit scenarios. Vasu is a small farmer and needs credit to grow 1.5 hectares of land. He received a loan from the village farmer for several years at 3% monthly interest. %36 annually. At the beginning of the harvest season, merchant supplies produce on credit and are repaid when the crops are ready for the harvest. In addition to interest on loans, merchants ask farmers to make a promise to sell their crops to them. In this way, the seller can guarantee that the money will be repaid promptly. Also, since the price of the crop after harvest is low, the trader can profit by buying the crop from the farmer at a low price and selling it when the price rises. Arun is a farmer and owns 7 hectares of land. He is one of the few people who can get a bank loan to grow. The loan has an interest rate of 10% per annum and can be repaid at any time for up to 3 years. After the harvest, Arun plans to sell some of the harvest to repay the loan. Next, he wants to store the remaining potatoes in a nearby town warehouse and use the cold storage receipts to apply to the bank for a new loan. Banks offer this option to farmers who take out agricultural loans. Terms of credit: interest rate, collateral, documentation requirement, and the mode of repayment together comprise the terms of credit. Number 1, interest rates is a rate that is decided while borrowing and lending loans. Interest rate is mentioned in the document. Number 2, collateral. It is an asset that the borrower owns, like a house, shop, property, etc. It is used to take loans. Number 3, documentation required. The borrower, before lending money, check all the documents related to the employment record and income earned by the borrower. Point number 4, mode of payment. It is the duration in which the loan is to be repaid. Long-term loans can be repaid in 12 months, 6 months, or monthly installments. The formal sources of loans. The formal source of loans that the government registers are followed by laws and regulations. Social welfare is the primary motive for the formal sources. The RBI regulates the activities of formal credit sources. Formal sources typically charge lower interest rates. Examples: banks and cooperative societies. Informal source of loans. The informal sources include all small and scattered units that are generally beyond the government's control, they must obey its laws and regulations. The profit making is the primary motive for informal sources. No organization controls credit activities in informal sources. They charge much higher interest rates for informal sources. Examples: moneylenders, merchants, workers, relatives and friends, etc. Self-help groups for the poor. The idea behind self-help groups is to organize rural poor, especially women, into small groups and pool their savings. To help poor households to get loans at cheaper rates and without difficulty. To create self-employment opportunities for the members. Example: for buying seeds, fertilizers, raw materials, for acquiring assets like sewing machine, handlooms, cattle, etc. These groups are meant to make women financially self-reliant. These groups aim to save the rural poor section from the traps of moneylenders who charge high interest rates. Conclusion: credit can positively impact economic growth by facilitating capital accumulation, innovation, and productivity. Credit development and stability vary across countries and regions, depending on the level of financial inclusion, regulation, and innovation.